So is there a way to protect yourself against these kinds of black swan events that we're seeing right now using ETFs? Maybe. Well, let's bring in Kristen Magoon from Amplify. Kristen, you have a black swan ETF designed exactly for this. The symbol is SWAN. Could you briefly and simply tell us what it does and how would it provide protection against something like a coronavirus outbreak?
Yeah, hi, Bob. So really the theory behind Black Swan is to own S&P exposure, but to also own U.S. Treasuries. You know, during times of market crisis, Treasuries are bought up like crazy, and they act as a great negative correlated asset to equity exposure. So the fund actually has about 65% exposure to U.S. Treasuries, about 35% exposure to the returns of the S&P 500. Last year, the fund returned 21%, 22% in a nice upward moving market. This year, the funds had about a little over 5% return coming into today, 12% ahead of the S&P 500 year to date. And we're seeing positive moves today.
We could clearly see the SWAN, which is the white line here, outperforming the S&P 500 in the last several weeks as coronavirus has hit. But how often do you say rebalance? I mean, you're obviously holding stocks and bonds. How often would you move more into stocks and less into bonds? I mean, how often does that rebalancing actually happen?
So it happens twice a year. It happens in December and June, and that rebalance really resets the portfolio allocation. But in general, the exposure is fairly constant to about a 65% exposure to U.S. Treasuries and about a 35% exposure to the S&P 500. This works a lot like a traditional balanced portfolio, but really shines during times in market crisis.
This is exactly what it is. It's a 60-40, or you have 65-35, but it's a 60-40 balanced portfolio essentially in a single ETF.
Yeah, and while this has done great, I think investors were looking for these kinds of safety plays, whether they're min-vol funds like USMV or Christian's fund here, Swan. There's others in the market, Tail, the Buffer series from Innovator. The important thing is you really have to understand the mechanics of how these things are going to work, because just in this year so far, we've seen a 30% dispersion of returns between the best performing and worst performing quote unquote tail risk
because it depends on what you've got invested in and how often you'll rebalance.
Exactly, and whether or not you've got triggers, right? Some of the funds in this space trigger based on things like 200-day moving average. In fast moving markets like that, they may not trigger, so you've really got to be careful.
Samara, you've seen a lot of interest, of course, in minimum vol, and iShares has several of these products that were really big last year that basically just tries to figure out ways to tamp it down volatility. Minimum vol doesn't own bonds, but it's all part of the same idea.
And factors like minimum vol, like quality, companies with strong balance sheets. And also we're hearing a lot of conversations around just other sources of uncorrelated risk, like gold or like mortgages. In this environment, MBB and IAU.
Kristen, do you always is it always going to stay roughly 65-35? In other words, if all of a sudden the actual weight's a little heavier, it's 75-25, do you rebalance down? Is it always the same target that you're having, or do you change it based on other criteria?
Yeah, it's a great question. It stays the same. It rebalances twice a year, but that target is the same. This is a fund that does work and hedge against black swan risks, but also something you can hold in an upward moving market. So it's really a core holding.